Hello, welcome to this broadcast on account access and financial education for youth participating in employment programs, hosted by the National Credit Union Administration, NCUA, and Federal Deposit Insurance Corporation, FDIC. We are so happy that workforce programs, financial institutions, and other stakeholders from across the country are able to join this program to learn more about how to improve the financial capability of America's youth. I'm Ken Worthy, Financial Literacy Program Officer with the NCUA's Office of Consumer Financial Protection. I will be your moderator for this broadcast alongside my colleague, Tracy Morris, Senior Community Affairs Specialist with the FDIC's Division of Depositor and Consumer Protection. Before we begin, please follow along as I review the information on your screen for the best viewing experience. Please adjust the volume on your computer so that you can hear the webinar clearly. To increase the size of your slides, drag the bottom right corner of the presentation viewer. Please allow pop-ups from this site for it to function properly. Download the presentation by clicking on the PDF file under the Resource widget. Use the Ask a Question feature on the left side of your console at any time in order to ask a question. We will address these questions at the end of the broadcast. This webinar will be closed captioned and available for on-demand viewing on ncua.gov in the coming weeks. A quick reminder, the views and opinions expressed during this broadcast are those of the presenters and do not reflect the official views of, nor should be considered an endorsement by, the National Credit Union Administration's Board of Directors, its management, or staff. The FDIC and NCUA have partnered for many years now on initiatives geared at improving the financial capability of young people across the country. We have placed special focus on promoting ways young people can gain access to federally insured credit union and bank accounts alongside financial literacy education. Now, Tracy Morris will provide an overview of what we plan to cover on this broadcast. Tracy?
Thank you, Ken. The FDIC is pleased to collaborate with the NCUA and welcome you to today's webinar. A 2015 report published by the President's Advisory Council on Financial Capability for Young Americans included recommendations for improving financial capability among the nation's youth. The recommendation that we highlight today is combining youth employment opportunities with financial education and account access. We have an exciting lineup of speakers. First, you'll hear from Matthew Bellaris, Director of the NCUA's Office of Consumer Financial Protection, followed by Emerson Hall, Associate Director of the FDIC's Community Affairs Branch. They will discuss their agency's commitment to financial education and the importance of youth account access. Amelia O'Rourke Owens will talk about the research on youth accounts and why they are so important. She'll also discuss her organization's role in helping youth set their own financial goals. Up next, Ken will lead a panel discussion among two financial institutions and their workforce partners. They'll talk about their partnerships and the challenges they work through in order to open checking or savings accounts for the youth in their programs. While they are speaking, we encourage you to use the Q&A to ask questions. Our panel will answer as many as possible after their presentation. Then Ken and I will take a few minutes to tell you about the resources created by our agencies along with other federal resources which support youth financial capability. With summer fast approaching, now is a great time to explore partnerships between workforce and financial institutions. In wrapping up, we'll provide information on how to contact us to help find a partner to support youth workforce programs in your community. And NCUA and FDIC are available to help. Thank you for joining, and we hope this webinar will provide you with the information you need to pursue youth financial capability in your communities. Now, I would like to turn the webinar over to Director Bolaris and Associate Director Hall. Director Bolaris?
Thank you, Tracy. I'd like to welcome all the financial institutions, youth workforce programs, and others interested in this important topic in joining us on this webinar during National Financial Capability Month. You are doing such important work in communities across the country, and we hope the information provided on this broadcast is informative and helpful to you. Your efforts to provide young people with financial education and access to federally insured credit union and bank accounts are a critical part of the path to financial stability and sustainability. Research outlined in the U.S. National Strategy on Financial Literacy suggests young Americans have low levels of financial capability, which, over time, creates challenges with building long-term economic stability, financial well-being, and wealth accumulation. This is particularly true for young people in economically challenged and underserved communities. Financial education, coupled with distinct life events like receiving your first paycheck, can help better prepare young people for the financial responsibilities of adulthood. Providing young people with a convenient, safe, youth-friendly account option to direct deposit their paycheck can help them save a significant portion of their pay that would otherwise be subject to transaction costs from check cashing or minimum balance fees. It also provides the perfect opportunity to encourage young people to develop strong saving habits by paying themselves first and setting aside a portion of their income for a future need. I want to take a moment to reflect on the credit union mission and how it relates to youth financial capability. Under the Federal Credit Union Act, promoting financial literacy is a core credit union mission. Credit unions are not-for-profit, cooperative financial institutions that are owned and controlled by their members. Credit unions are chartered for the very purpose of promoting thrift and responsible credit use to their members and communities they serve. Protecting and educating consumers is a key component of the credit union model. We know credit unions are delivering on this mission because NCUA's credit union profile and call report data indicate the majority of credit union members have access to financial education services through their credit unions. Such services include financial counseling, first-time homebuyer programs, and in-school credit union branches. Credit unions that provide youth savings and transaction or shared draft accounts typically have youth-friendly account features like no minimum or starting balance, zero or low monthly and minimum balance fees, no dormant or inactivity fees, and free and unrestricted access to member services and direct deposit. And additional information about youth-friendly account features is available on ncua.gov. Working together in a cooperative spirit on these issues with partners like the FDIC is a top priority at the NCUA. While credit unions serve the needs of their members and promote financial literacy within the communities they serve, the NCUA works to reinforce credit union efforts, raise consumer awareness, and increase access to credit union services. The NCUA also participates in national financial literacy initiatives, including the Financial Literacy and Education Commission, an interagency group created by Congress to improve the nation's financial literacy. Also, at mycreditunion.gov, we provide financial literacy and consumer financial protection information and resources to help credit unions, their member owners, and consumers with a variety of personal finance topics. These resources include interactive learning games for young people that will help them understand how to earn, spend, and save wisely. And we'll have more on these tools later in this webinar. Please do not hesitate to reach out to our team to help connect your youth employment programs with credit unions, or if you're a credit union that wants to connect with a local employment program, you may also reach out. We're here to assist. We at the NCUA also work hard on many related financial capability and economic inclusion issues through the agency's initiative on advancing communities through credit, education, stability, and support, or access. So stay tuned to ncua.gov for updates or to learn more about this critical initiative. I would also like to thank our long-term strategic partners at the FDIC, like Tracy Morris and Associate Director Hall. We appreciate the FDIC for co-hosting this broadcast to advance our shared commitment on expanding youth financial capability throughout the country. We look forward to our continued partnership on this issue and others. And now I'd like to welcome Associate Director Emerson Hall from the FDIC for his remarks. Emerson, over to you.
Thank you, Director Dolores. I'm delighted to join today's webinar on youth financial capability. It is an important and timely topic as many young people are gearing up for summer employment programs. For the workforce practitioners on the call today, you play a critical role in helping young people take the first steps toward financial capability, providing them with the opportunity to earn a paycheck. I often shared with my daughters as they became old enough to begin working. As a young person, having a job, any job builds character, and having the right attitude towards work and correct relationships with money will determine the quality of life you live. Workforce practitioners, along with financial institution representatives on today's webinar, are positioned to help youth take significant steps toward financial well-being. Opening an account at an insured depository institution, a bank, or credit union will be one of the most important steps a young person takes toward reaching their financial goals. Why? Because putting money in an FDIC-insured account offers financial safety, easy access to funds, savings from check cashing fees, and overall financial peace of mind. As many of you are aware of the benefits of having a bank or credit union account, I will briefly list a few advantages you should consider sharing with the youth you work with. Their money is safe. Keeping cash in their homes puts funds at risk of stolen, fire, flood, or loss. The money is protected against error and fraud. Access to the money is faster with no check cashing fee by having direct deposit. Online purchases can be made easily. And lastly, other financial products become available once a person has established an account relationship. I also want to make you aware of the Get Bank campaign FDIC is collaborating on with banks, credit unions, and other national partners. The Get Bank campaign is promoting a checkless checking account, which is a great option if the youth you're working with are considering opening their first account or considering other options. With a checkless account, youth can make purchases with a debit card instead of writing checks. A checkless account offers account holders to pay bills online or use a mobile app. Checkless accounts assist customers avoid spending more than the amount available in the account, which prevents overdraft charges. Young people should know it is not required to have a lot of money to open an account. During today's webinar, you will hear about FDIC's Safe Account Template. The template provides guiding principles for offering cost-effective accounts that are affordable for consumers. Our goal is that as a result of today's webinar, youth employment practitioners and representatives from banks and credit unions will work together to help youth enter the financial mainstream at this point of their lives and to effectively manage money they earn. You will learn how 2 workforce programs partnered with financial institutions. You will hear about the challenges they had, how they overcame them, and how they will share that youth benefited from their work. Many of you in the webinar are familiar with the Workforce Innovation and Opportunity Act, requirement to make financial education available to youth participating in its formula-funded programs. The regulations state the importance of providing opportunities that will allow youth to put what they have learned into practice, and specifically call out helping youth access safe, sustainable, and affordable financial products that enable money management and savings. There may be some fear that youth will mismanage their accounts, but with the right account and the right training, these serve as guardrails to mitigate mismanagement. At the end of today's program, you will hear about FDIC's free financial education curricula, Money Smart, Money Smart is available computer-based or instructor-led options. We'll also have Money Smart Alliance Coalition made up of banks and other organizations that are willing to teach financial education free of charge in their community. If you're interested in locating or establishing partnerships for this initiative, I encourage you to reach out to FDIC Senior Community Affairs Specialist Tracy Morris. Whether you are a banker and would like to identify a workforce program near you to teach financial education or to offer accounts, or a workforce practitioner needing help to identify a bank that provides affordable account access, or have an interest in developing a partnership to support financial education, we want to be of assistance. I will close with, I am sure that the bankers and credit union officials on the call will agree that a viable relationship with a financial institution is just the beginning of leading a financially sound life. By partnering, everyone on today's call can help set you on the path to building those relationships. Thank you and enjoy the webinar. Ken, back to you.
Thank you, Director Ballars and Associate Director Hall, for your remarks. Now we will transition to Amelia O'Rourke Owens, Associate Director for America Saves for Young Workers, an initiative of Consumer Federation of America. Amelia will go over some of the latest research, information, and data on these programs. Amelia?
Thank you, Ken. Thank you for having me here today. I'm delighted to join with the NCUA and FDIC on this issue. As Mr. Worthy said, I'm the Associate Director of America Saves. Our mission is to empower all, particularly those who are financially vulnerable, to save effectively in order to reduce debt and build wealth. And I wanted to start today by giving all of the attendees on the call some context on our program and the insights that we've gleaned since launching America Saves for Young Workers in 2015. I'd like to build on some of the highlights and benefits shared by Director Ballars and Associate Director Hall. So America Saves for Young Workers, we work with youth employers nationwide who collectively employ over 200,000 youth. And these employers are city, county government programs and nonprofit employment programs with a variety of funding sources. We provide online financial capability training for free directly to youth employees. And we focus on two variables to support building an automatic savings habit. Those are direct deposit and account ownership. And then through our online program, we're able to track metrics for individual programs and in aggregate over the course of the year. And this includes insights from our automated communications centered around the youth employees' savings goals. I'm so excited for all of the attendees to hear from the two workforce programs and supporting bank and credit union later on in this call to see how this can be implemented in your community. But before we get into the nuts and bolts, I'd like to lay out why this work is so important, in addition to what's already been said. A first job is a critical juncture in a young person's life. It's their first professional experience, but it's also their first earning opportunity. And that means it's our first chance at establishing financial behaviors anew. Instead of changing behaviors, we get the opportunity at learned behaviors. So the problem is this. I put to everyone on the call today, when did you open your first account? How did you open it? Because that's a point of crystallization in the process. The problem with crystallization is that there are essentially two categories. There are teens with parents who open accounts at their own institutions. And then there are teens with no adults in their lives or who have adults in their lives who are or underbanked. And at that moment, when these teens get their first jobs, for the most part, they fall into whichever one of those categories they're coming from. Credit unions and banks working with youth employers can disrupt this pattern. So switching gears back to the nitty-gritty of our program, in order to encourage young workers to pay themselves first, we have some automated programs in our online financial capability training. But it's not an effective strategy simply to tell a 17-year-old at their first job that they need to pay themselves first. We found that we must show them how and provide support leading up to and during their employment. So to that end, we include with Young Workers Savings Plan the option to select their savings goals, and we also emphasize the importance of direct deposit in a lot of our first touch opportunities with those youth employees. And I wanted to flag these side-by-side comparisons to everyone on the call to put into context the changes that we've seen since the onset of COVID-19. As you can see, there was a significant decrease in direct deposit usage from 2019 to 2020. Many employers had to reduce hours, number of youth employees, and or pay if they were able to continue their program at all in 2020. But also, what this is a flag to me is that we need to remain hands-on. This is a representation of those employees who were hired, and they significantly dropped off in their direct deposit utilization. So we need to remain engaged. Additionally, you can see in the savings goals that the young people were choosing for themselves that they changed pretty significantly between the 2 years. Until 2019, clothing and shoes had been our #1 nationally chosen goal. But in 2020, it fell to our third selected goal, reflecting the economic anxiety that so many Americans were experiencing last summer and are still experiencing today. Shifting gears, I'd like to examine some of the long-term impacts, including account retention and built behaviors. Little differences add up. And we know that, especially with young people. First, young folks who complete our program have higher rates of savings account ownership. They exceed rates of savings account ownership of national low-income teens by 34%. Additionally, they do establish a habit, even if it's hard to believe for those of you on the call who work with or have teens of your own. Following their summer employment, 80% of young workers had established a savings pattern, a significant increase of over 50%. And then that habit continues. Young people reported that after their summer work experience, 61% had made a deposit 8 months after their employment ended. So even when they're no longer in that regular employment opportunity, that associative behavior of earning and saving continues. And lastly, it's easy to stop at the numbers because we look at this on a yearly basis and we want to look at this on a national level. But specifically, account ownership is something that sticks with young people. But we can lose sight of the individual places, programs, and people who actually experience these changes. I wanted to highlight that even with the headwinds in 2020, SYEP Bridge reported their highest ever number of banked youth and direct deposit users. Summer Jobs Connect Miami adapted to the plan and allowed young people for the first time to open their accounts from the safety of their homes. And 50% of young workers and higher Kansas City youth opened new first-time accounts, a program record. And you don't have to take my word for it. This young worker from Chicago said that this experience has encouraged them to start a savings account. They had never had one before, but they just kept money to the side. So the benefits of obtaining a savings account provided them a designated space that they don't touch or transfer their money out of, but only into. Going back to the crystallization I discussed at the beginning of this presentation, I'd like to put this question to listeners. Left to their own devices, would youth go out to get their own accounts? And if they did, would they find the account that is best suited to their needs? And in all of these cases, what long-term consequences might come from that? I argue that account ownership is a cornerstone to financial health. It provides stability, financial confidence, and a vehicle to practice healthy financial behaviors such as savings. Building financial health for young people, particularly those from low-income families, is essential to building wealth in America. And so I will close the same way that I started today How can your institution or program be the solution to these problems?
Thank you, Amelia. What a perfect segue into our financial institutions and workforce panel that we have now, who actually have programs featuring many of the great benefits that you just presented on. So let me go ahead and introduce our panel. I'd like to welcome Sylvia Rincon, a Senior Vice President of Member Experience at Latino Community Credit Union in Durham, North Carolina, and her strategic partner, Julie Wells, Vice President of Strategy with the Durham Children's Initiative. We also have Elena Parker, Director of Relationship Banking with First Metro Bank in Muscle Shoals, Alabama, and her partner, Dr. Corey Beal, Director of Partnerships and Workforce Innovation at Florence High School in Florence, Alabama. Thank you all for taking time out of your schedules to share your great expertise with us on these programs. We'll start off with a 5 to 6 minute introduction of your program, and then we'll get into some questions after your intro to your program. A reminder to the audience, if you have any questions for our expert panel, please type them into the Ask the Question box for us to get to during our next segment. Let's start off with Ms. Rincon and Ms. Wells to talk about your partnership in your programs, and then we'll go to our bank partners and program.
Thank you so much. Good afternoon, everyone. My name is Julie Wells, and I am in Durham, North Carolina, and I'm currently serving as the Vice President of Strategy at the Durham Children's Initiative. Last July, a nonprofit I was running called Partners for Youth Opportunity actually merged to create this larger institution. So throughout this conversation, you may hear me reference Partners for Youth Opportunity. Just wanted to be clear that we are now the same organization. Sylvia, would like to introduce yourself?
Good afternoon, all. My name is Sylvia Rincon, and I'm with Latino Community Credit Union. We are located in North Carolina. Right now, we serve over 96,000 members across the state and across the country, and we have a network of branches of 14 branches across the state. And we're really happy to be here to share our experience offering or being the solution for workforce development programs here in Durham.
So I'd like to start out by giving some context to how we made the connection between our community-based organization and the Latino Community Credit Union. We were working with 14 to 24-year-olds in a variety of capacities over a number of years, and workforce development was a strong component of our work. We came across a stat from Prosperity Now that told us if young people graduated from high school with a minimum of $500 in a savings account, their college application rate and their college retention and completion rate increased 4 to 5 times. We were very, very interested in finding ways to link our workforce development efforts to our college access, retention, and completion efforts, and therefore started to explore what did savings look like for young people. We were very motivated to also find a financial partner within our community who was willing to go on this journey with us, and we were so fortunate to come across Latino Community Credit Union, who really opened their doors and gave access to our staff to create a very youth-centric response to savings and checking accounts. Sylvia, you want to speak about LCCU's experience?
Yeah, back in 2016, when we met Julie and Partners for Youth Opportunity, we were serving our memberships. We were offering youth accounts for our members, but to be honest, they were not too often used. And we think it was because there was a misconnection with the needs of our membership. So when we met Julie and she shared all this information with us, it was, love at the first sight. We are We have a very strong financial education program that we offer to our members, but it was geared towards adults, immigrants that have come to this country and need to understand this financial system to be able to integrate into it and grow and take advantage of all the opportunities that they can be presented. So we started working together and understanding how us as a credit union can be a component of their programming and how we were able to serve as a tool for them to offer better opportunities for their participants.
And our participants that we were serving, again, who were adolescents as young as 14 years old, a majority of those young people were economically marginalized. They were coming from first-generation immigrant families. Many had family members incarcerated. And so, needless to say, they had a lot of pressures on them economically. But what made LCCU such an important partner for us is that their institutions were dual language. That made them accessible for all of our families. We didn't have to think about accommodations, particularly for our Spanish speakers. There was a seamless ability to work with folks who had different residency and documentation status. We were so blessed to have accessible leadership. I was able to sit down with the president and the CEO, as well as Sylvia and other members of her team, as we developed these ideas, tried things, changed things. It was incredibly important that we were dealing with senior leadership in order to implement change quickly, and that we were both committed to work small and build. We work with a population of about 125 young people. So we began in cohorts of 25 to 30 opening accounts to make changes as we needed. Through the process, we learned quite a bit about youth and how they save and how families support their young people's savings. A lot of these have been echoed by statements from Amelia and others on this call, but I just want to reinforce that we know that youth learn when they can immediately put into practice the lessons that are being taught. So with our partnership with LCCU, we didn't only create an opportunity for young people to learn about financial education and capability, we immediately then put them into jobs where they had the opportunity to earn money, and we immediately opened up bank accounts, both savings and checking. When we taught them about how to have a first job, asking for direct deposit became an immediate question, and we created a mechanism where we could show them how well that worked. We were convinced that when we started this program that it would be a struggle to get young people to save. Our original goal was to ask our students to save 20% of what they made. Consistently year over year, our young people knocked that out of the ballpark. We had 40% average savings over a 4-year period of time. And last year during COVID, with an older population of 18 to 24-year-olds, when given opportunities, they saved 55% of everything they made in internships. We also saw very clearly the importance of having accommodating financial institutions. We figured out together how to create non-custodial accounts with low minimum balances, no fee, use checking accounts, like Sylvia said, adapting those financial capability trainings to be youth-centric, and also creating some really innovative youth credit building products that we could start to introduce to our 17 and 18-year-olds, including encouraging them to move the $500 they had saved into short-term CDs. We love matching savings. That was an integral part of the work that we did to tell young people that we see you, we recognize your efforts, and we want to help you build your assets as quickly as we can. Really helps to mobilize their ability to save hundreds and hundreds of dollars for themselves. In the span of 4 years, we helped 90 young people save $90,000. And then finally, just youth flexibility and how they use their savings. It was really important for us to put some parameters around access to savings. But then at high school graduation, this personal savings account works so differently than a college savings account because it allowed our young people to invest in themselves in a number of ways. Happy to answer questions. Go ahead, Sylvia.
Yeah, just to add what Julie was saying, on our part, on the credit union part, we can think that this is not too sexy because we're working with a small cohort and we're dedicating a lot of energy and capacity for these programs. But what we have, what our experience has showed is that if we provide these tools to young people, we are creating a relationship. So it's not just, they open the account, they get their direct deposit, and then they close the account. They start the relationship with us, and after 5 years, they're still with us. Like Julie said, they're accessing other products and services. They keep saving. We are creating behaviors. We are encouraging behaviors, and that's so important because we as a credit union have to be there for our members. And the time that we dedicate to these programs is very valuable, and we also have been able to escalate this and advise other workforce development organizations to introduce this component to their programming so they can be more successful in what they do.
Thank you so much. A lot of great information there. Let's go ahead and get information also from Ms. Parker and Dr. Beal. You can go ahead and give us an overview of your programs, and then we'll get to questions.
Good afternoon, everyone. My name is Elena Parker. I'm with First Metro Bank, and I have Dr. Beal here with me. He's from Florence High School, and we wanted to talk a little bit about our programs. I'm going to kick it off and tell you a little bit about First Metro Bank and what we do. We, beginning in 2013, created student-operated banks within local high schools. So we have 6 local high schools in which we have student-operated banks that are completely run by students. They apply for the position and get to serve as student tellers, and they earn a grade for their participation. When we began kicking off this program, we thought, man, this is going to be so cool. All these students are going to come in and be able to open accounts, and their parents can come in and sign with them. Well, we found out pretty quickly that there are a lot of students, more than we would have realized, ages 15 to 18. The age of majority here in Alabama is 19. So for our purposes, when I say teen, I mean ages 14 to 18 or 15 to 18. But they don't have a trusted adult in their life with whom they can have a joint ownership type of account. So we actually reached out to the Community Affairs Office with the FDIC. I talked to Mr. John Olson, I don't know how many times, to try to find a way to make it work, try to find a way to say yes to help these kids. And what we found out pretty quickly was that we would be able to offer an account to these students that did not require a joint owner. So these kids have an account in their name only, and in order for that to work, the bank assumes 100% of that risk. So in all that time that we've had these student-operated banks, we've not lost not one penny. These accounts have a $1 minimum balance, $1 opening deposit required. We give the kids everything that they need, every product and service that they need. But Dr. Beal, we met him pretty early on because he has an amazing program at Florence High School, and a lot of his students were the ones with whom we have relationships and that we were serving. So it was just sort of a natural fit. And I'll let him tell a little bit about his program, but I think you'll be able to see how both of our programs sort of came together to benefit these students.
Good afternoon, everyone. My name is Dr. Corey Beal. I am the Director of Partnerships and Workforce Innovation and serve the Florence City School District. I appreciate being able to be a part of this because I think it's very critical work. It's imperative that we teach these young people positive habits. So I've got a charge of supervising 2 award-winning programs that focus on career integration and basically workforce development. And what we've learned, we serve approximately 200 students in the district, and what we've learned through these models is it's imperative to incorporate 2 different teaching aspects. The soft skill component, communication, employee adaptability, high expectations, a lot of those problem-solving applications, and then the other being financial literacy. And we have been fortunate to partner with First Metro in that respect. And it's really, you've got two mindsets. You've got a proactive, you've got a reactive. And we try to operate on a proactive mindset because we are setting them up for how they're going to function as they transition through life. And if you're proactive in this approach and you're teaching them positive financial literacy habits early, then you're not having to modify negative habits on the back end. So these students, what we're teaching them basically is, it doesn't matter how much money you're making if you're not a good steward of your money and know how to operate within a budget, learning about credit, all those financial elements. And basically we're setting them up to fail and we're doing them a disservice. And I'm a huge proponent. I think that every student in high school needs a financial literacy curriculum before they exit.
And so we just sort of have joined together over the years. So we come in and we talk to his students in his various programs, and then we also give them the ability to open an account, at the student operator branch. Their direct deposits go there. We have a question in here about when you say every product and service, does this include courtesy overdraft? No, ma'am, it does not. We have a zero overdraft for these students just because that is an extension of credit, and we can't offer an extension of credit to a minor. So that was a great question. But when I say every product and service, I mean, online banking, mobile banking, Apple Pay, Google Pay, all of those types of products and services. So we have been really fortunate to work together throughout this partnership to be able to provide these students with financial literacy, and it sort of falls under our bank's financial literacy outreach umbrella, which hits, fourth graders, eighth graders, juniors and seniors, and then also student-operated branches. So that's sort of a quick overview of our programs. If anyone has any questions, like Mr. Worthy said, we'll be here at the end to answer all of your questions.
Wonderful. Thank you, Ms. Parker and Dr. Beal. I'll go ahead and start off with some questions, and then for everyone listening in, we see the questions coming in. Continue to type them in the Ask a Question feature on the console window so that we can get to them in our next session that my colleague Tracy Morris will moderate. I'm just going to follow up with some questions about some of the features of the accounts that you offer, if we can go a little bit more into depth of those. But starting off with some of the barriers, the NCUA and FDIC has been a part of the sort of the national dialogue on many of these accounts, and we know that programs often struggle with the custodial versus non-custodial accounts, deciding on the pros and cons of offering the non-custodials specifically. The documentary identification requirements that come into play when the institutions do offer those types of accounts. And also, a couple of you have hit on this about some of the issues maybe at the household level with some of the youth, and the check systems reporting, the negative reporting on some of the check systems reports that come up when offering the transaction account. Can you talk a little bit more about how you overcame some of these barriers that we know exist and that we know your programs are going through, and then also identify any additional challenges you may be going through that you can raise here and educate our audience on. Let's go ahead and start off with our credit union and their partner.
I agree. That is extremely important in order to be successful to offer non-custodial accounts. That's one of the barriers that we encounter when we were serving this young population, and perhaps they wanted to be the ones the only ones accessing their money. So we rapidly adjusted and created a non-custodial account, checking account with no minimum balance, no minimum opening requirement, no checks, because either way, at these times of age, young people don't know what a check is. they do have access to a debit card and to our ATM network. Regarding the identification process, we understood that many of the youth that we serve didn't have either a driver's license or a state ID. So we accept, or we open these accounts with a student ID. It doesn't need to have if it doesn't have a picture, we can have a non-picture ID, but also a validation or a letter from the, in this case, from Partners of Youth Opportunity, stating that they do know who they are. Because, to be honest, we trusted all the application process that they already did with this group, so we knew that they already identified them. So we were not that strict on the documentation process. Something that I forgot to mention is that we do not only offer these accounts for the partnerships that we have in the community, we also offer them to all our membership. And so far, the risk has been very low. The credit union will have to take the risk on, because if something goes wrong, well, there is not much that we can do. But like I said, we haven't had those issues, so the risk is very minimum. Regarding the check, regarding the check systems, we do run check systems when we open these accounts, but most of the times, since this is the first account, we don't find many issues regarding check systems.
Oh, that's great. That's great. Ms. Parker and Dr. Beal, did you want to add anything, or Ms. Wells?
Yes, I wanted to say that as far as the CIP process goes with us, we do the same sort of thing. We take a student ID, but we also have a form that the school can sign for us that verifies the student and their address. And we have been through multiple exams, BSA, AML type things. And so, the FDIC and the State Banking Department have looked at our process multiple times too and been very happy with the way we do that. And that is not something that's proprietary information for our bank. We gladly share that with anyone who would like to have that information. So if anyone would like to see our CIP process, if they want to reach out to First Metro Bank, we'll be glad to share it. Dr. Beal?
Also, I wanted to include that what we learned early on is, I would say 95% of the students, when they arrive at our door at 16, when we're transitioning them into an employment status, they have minimal to no financial knowledge. We had several students that were, I used to call it eating your check. They would go to Zaxby's 5 days a week and their check was gone. They had no self-control or ability to operate within a budget. So we knew quick that we had to integrate that. Also, is they learn financial independence, and these kids are craving that. Financial independence, they want to make their own money, and they want to learn how to manage it and how to operate independently. They're in the process of transitioning, out of high school and setting their life up. So we've noticed that as they learn those skills, it is a self-esteem game changer. Makes them feel better about themselves. They're confident. Mm-hmm. They're making their own money, and they're learning how to, to build a savings as well.
And perhaps we can build on that, Dr. Beal and Ms. Parker. You can start us off with talking a little bit more about the financial literacy and financial education perspective of your program or features of your program.
So our program, our financial literacy outreach program here at this bank is really, really large. We start with fourth graders going in and talking to them about, is saving money a want or a need? And we sort of start there and build. We see them again in 8th grade. We see them again in 11th and 12th grade talking about credit. And then we also have the student-operated banks in the 6 high schools. And then we also have another part of it that's elder financial exploitation prevention. So we joke that we talk to everyone from preschoolers to our elderly population about financial literacy, because it is the one thing that affects 100% of the population for 100% of their life. And so with Dr. Beal, and having the opportunity to actually come in and talk to his students and sort of build on what we've done over time and get them from you know, not eating their paycheck to actually budgeting and paying themselves first. You know, being able to see that process with those kids is hugely, vastly important to us, because we don't want to just check a box and say, yeah, we went and talked to them. We want to actually make a change in these students' lives so that they're able to graduate from high school financially stable on their own 2 feet. You know, we had one student who went through the Southwire program, and for a multitude of reasons, she was pretty much in this world on her own, except for the child that she had that was 2 years old when she graduated from high school. So this student had to pay for daycare, pay for car insurance, save up and buy a vehicle. And thanks to, you know, Mr. Beal and the people who work with him, and, you know, some of the people here at First Metro Bank, this student was able to graduate from high school. We got her, you know, in with a local university, and we're able to get her housing and a scholarship, and, you know, Dr. Beal was able to facilitate a lot of that, but she also graduated with a car that she owned that didn't have payments on it and about $4,000 in a savings account, and had a job to be able to transition into thanks to everything she learned through his program. So that's just one story out of 1,000 that he could tell about success stories and why it's so impactful and so important.
That's
I think
incredible.
the key also is working collectively.
Yes.
Collectively.
Absolutely. Well, and Ms. Rincon and Ms. Wells, do you want to maybe talk a little bit about the financial education features of your program? And then also, if you could lead into our next question about program costs and how you fund your program. You know, how does that work between the financial institution and the community partner? And then we'll switch back over to Ms. Parker and Dr. Beal.
Julie, you want to?
Sure. Yeah. So the financial capability training that we have implemented with our young people has continued to morph and change. And you know, at the beginning, we had seminars with youth and their families together and separate. We have done, you know, multiple sessions, and we've really honed it now into the material that really lands with our young people, and we tailor it for age groups, remembering that we start with kids as young as 14 years old. What we have found is that young people are eager just to understand some of the terminology. They really need to get familiar with terminology like direct deposit and credit and, you know, accounts. Just helping them understand those structures was really important. And then what I saw them really plugging into was the idea of connecting with a savings goal, understanding that small bits of money led up to large pots of money, and large pots of money were what made big actions happen for them. You know, and our staff at our community-based organization has gone through it so much with LCCU. We also feel very capable of creating and implementing our own financial capability training, but we continue to partner with LCCU because we think that it is really important for our young people to get to know the folks within the financial institution that they use, because they then see that these are real people, they care about their money, and they're there to help support them and answer questions.
Yeah, something that we also did is that when we were providing the financial education workshops for the PYO students, we linked all the information that we were giving with the products that they were actually using. So if we were talking about the importance of direct deposit, we set up the direct deposit right there. If we were talking about, you know, how to transfer money and start saving, we open the savings account right there. We access the online banking right there. We set up the transfer right there. That is really, really important because, and mostly for young people, that is very different when you talk, but when you pair up with actions, it makes a big difference.
And on the cost, sorry,
yes.
Go ahead.
No, I was gonna circle back to program costs. So before there's a cost involved, there's really just a value shift. I think I'm so excited to hear that you know, federal funding is moving in a direction where workforce development programs are mandated to have financial capability. We have really learned that and continue to push that within our community, that financial capability and savings aren't an add-on to our workforce development program. They are integral to any workforce development program. So the same staff who was implementing soft skills training and finding employers now became upskilled in terms of asset development for young people and these saving mechanisms. The folks who were running my books and doing my accounting, they upskilled themselves on how to work directly with LCCU to make direct deposits instead of writing checks out to our kids. It became a part of our culture. Therefore, it wasn't that we added a new full-time staff on. We all adapted and adjusted our skills to support this effort because we believe it was so important. In terms of matching savings, that was somewhere that we really targeted raising money. That happened at both the local level and the national level. The one-to-one fund through Prosperity Now helps lift up organizations that are helping young people save in a variety of ways, from children's savings accounts all the way up to individual development accounts, such as the ones that we're working with. And what I found is that financial institutions, specifically banks who have community funds, they get extremely excited about these initiatives. And I've been very pleasantly surprised that even though LCCU was our chosen partner for both the accounts and the financial capability, other banks and financial institutions supported our work and supported those matching funds for our young people, even if their specific institutions weren't the ones delivering the services or housing the accounts.
Wonderful. Excellent information. Ms. Parker and Dr. Bill, maybe you could also hit on the cost aspect. And what I'm trying to get to is the business case for a lot of the institutions. Obviously, there is, and hopefully you can speak to, in addition to the cost, what is the business case, right? Over the long term, this is about building relationships also with the young people and provides opportunities for not only to give them lifelong financial education, but also the products and services that come with in the future for these young people. Could you talk about the cost and then lead into the lifelong sort of relationship building that you're working on?
Yes, sir. So I'll talk about cost and I'll let Dr. Bill jump in about the lifelong relationship sort of side of it. It is somewhat costly to get this program started. We had to really think about that and decide what we wanted to do. If you guys will remember, at the end of 2012, the Sandy Hook tragedy occurred. So we were looking at implementing student banks in 2013. So we had to stop and really reevaluate and think, we're putting money inside of a high school. Is that going to make it a target? What safety measures are available? What safety equipment do we need to have? How are we going to train these students? And so that's one small aspect of cost, because we're not going to put something out there if it is dangerous in any way to any student. We're going to mitigate every possible risk. So to get started, we built actual banks with actual ADA compliant teller lines, small, what we call like the night teller safes where they could keep their money, all of that stuff. So that was a significant investment. And if you think about that over 6 high schools, it was a significant investment. So when I was, talking to our directors about it and sort of begging for this money, one of the things I wanted to know was, is this going to pay off in the long run? And I had to just be honest and say, no, that it wasn't. But it's the right thing to do. And you can include it in your community reinvestment. There are other ways that you can sort of justify it. But long term, the way that you justify it is you're doing the right thing for the community that you are privileged to serve. And that is your duty and that is your call when you are serving a community. And so Dr. Bill can kind of talk a little bit more about, the relationship that, First Metro Bank and Florence have sort of built together, an ongoing relationship there. But as far as costs, getting started is expensive, maintaining is not as expensive, and it's just the right thing to do.
So we are extremely fortunate to have First Metro at our access to them, because what they do, they will actually come on site and assist these students with setting up their checking savings account, getting their information, that expedites that, facilitates it, gives them some understanding of how, how to utilize that. And of course, that starts the relationship building process. That sets that in motion. So if we incorporate the financial literacy into our curriculum, we stress the importance of that, having a relationship, having a go-to at a financial institution. We teach them that your Social Security number is going to follow you, and when they type your number in, it tracks behavior. You've either got positive behavior habits financially, or you've got negative, and of course you're building your credit and your financial reputation, if you will. So. We're doing that all in a proactive fashion. We did the data last year, and we have 2 extremely large workforce programs, both of which combine about 190 students, and they will earn over 1 year about $740,000 combined, all of the students. So that's a lot of money going through hands, and we want these kids to be good stewards of it and learn appropriate positive habits early.
And those are numbers that I can give to the board about the amount of money that's going to come through our bank and these students and these savings accounts and things. Those are numbers that you can use to justify your cost. But if you're looking for dollar, making money on your investment, you're probably not going to. But your relationship with the school, your ongoing relationship with the student, and, in the words of our president, we kind of hope that these students grow up and are not chronic overdrafters. That's sort of the whole point. We hope that they qualify for low interest rates. That's what we're trying to do, is build a stronger community. So that's sort of our line of thinking as far as cost goes.
Excellent. Ms. Rincon and Ms. Wells, anything to add before we transition to the Q&A panel?
I cannot agree more with Eliana. I mean, if we look at this only on the number side, maybe it's not too attractive, but like she said, it's the right thing to do. And we as a credit union, we're in the business of people helping people. And this is an investment. This is an investment in our youth. If we want to change, if we want to provide opportunities to the people that we serve, this is the best opportunity. We have seen so many examples of lives that's been transformed, of families that have been transformed because of these opportunities. So besides numbers and relationships that we can create and extra products that we can offer, this has to be something that is a way of doing business. If you do the right thing, the things will come later. So.
Excellent. Wonderful. Well, thank you all for this session, this panel session. We are now can transition to the question and answers from our audience. We've got a lot of questions coming in, and my colleague Tracy Morris has been going through them and has them teed up. Tracy?
Hi. Lots of great discussion. Thank you to the panelists. One question that I've seen a number of different times is relative to what do we consider youth. When we're talking about government programs, we tend to use the Department of Labor's definition of youth, which would be ages 14 to 24. Following on that particular question is, at what point can a young person get an account in his or her own name, a non-custodial account? And that will depend by it's state regulation, and then it is up to the bank's individual policy on if the state law allows it, then what does the bank want to do? And perhaps our two panelists, Sylvia and Elena, can speak to the age requirement when somebody can get a non-custodial account at their particular institution. But just a reminder that at the end of the day, it is a decision, a policy decision for the institution. So Elena and then Sylvia.
So this is Elena Parker. So for our purposes, you know, and keep in mind, it can vary by state as well, what your state banking department, and I'm not sure about the credit union side, what it's called there, but I know you guys will know. But you need to talk to whoever your state regulator is too. But for our purposes here in Alabama, we allow an account with sole ownership ages 15 and up. And we did that to sort of capture the market of kids who do not have an adult who they can trust, because what would happen is, you know, these kids would have their little job at a fast food place and their direct deposit would come in on Thursday, and the quote-unquote trusted adult who was their joint owner would go and take all the money out while that kid was at school. So we talked to the, you know, state banking department here, and then again, I told you guys, you know, Mr. Olson with FDIC Community Affairs Office deserves a big raise, because I drove him crazy for years with questions. You know, and I guess our whole theory here was it's free to ask, you know, and find out the information. So for our purposes, it's 15 to 18. But now keep in mind, in the state of Alabama, the age of majority is 19, not 18. So we have one more year than a lot of the other states.
For us, the youth checking account, the non-custodial accounts that we offer for youth are from ages in between 13 and 19 years old. And that was our decision, our systems. We offer children accounts from birth until 12, and then the youth accounts, and then after the member turns 20, the system immediately changed this account to a regular individual checking account that offers many benefits. So again, this was our decision based on our risk management, and so far it has worked really well.
And I'd also like for Amelia O'Rourke-Owens to weigh in on this question.
Thank you, Tracy. Adding on to what Elena and Sylvia have shared from their institution's experience, another resource for banks is the csbs.org has a map of the laws that apply for opening non-custodial accounts for under 18, and it's actually incredibly permitted. And the thing that I wanted to say to the banks and credit unions on the call today is that a lot of times you'll find that your regs department has found what is acceptable, and then sometimes that becomes what is interpreted as the outer boundaries of the, like, know your customer standards, for example. But that doesn't actually mean that that is the true threshold. And so I just wanted to put that out there and to add on, if there are any banks or credit unions on the call, really dig into that, because just because, you know, your institution has always only accepted driver's license, state IDs, or passports doesn't mean public school IDs aren't actually acceptable to meet the CIP. And then also I think that Elena mentioned some other, you know, really clever CIP workarounds. So just wanted to flag that for everybody on the call, that just because it is what is done is not, it's all that can be done.
Oh, 2 thumbs up to that. Just because it's what's done doesn't mean, I love that. I'm writing that down.
So let's see. There's a lot of great questions coming in. Again, I think there's a number of different questions around CIP, and just want to clarify from the panelists that it doesn't always you don't always require a driver's license per se. What other types of identification are available, or would y'all accept?
So most of our memberships are immigrants So we have a very flexible CIP or MIP policy. As long as they have a non-expired government ID, that's what we can use to open any type of account. So it can be a passport, it can be any government ID from any country. Regarding youth, we can accept, again, passports or student IDs or student IDs. And in case of working with any organization that had already done their due diligence identifying this person, it can be a letter just attesting to the identification process that they already put into place.
You know, I really don't want to get in trouble with our compliance officer by saying the wrong thing. But as far as our CIP process goes, we're, you know, a lot like Sylvia, you know, with the government-issued ID and then also with the student IDs. But the only thing I guess that would be a little bit different would be the school verification form that we created and sort of got approval for, you know, that we sent around. And basically what it is, it's where an administrator or the teacher who oversees one of the student-operated banks can write the student's name and the address that the school has on file for the student and then sign it as, you know, someone who's sort of witnessing that is the correct address for that student. And, you know, like I said earlier, I'm happy to share that it's not proprietary information. As far as we're concerned, the more financial literacy and the more young people who are able to open accounts, the better. If you just want to reach out to Tracy, she'll be able to get that to you. I will send it to her and you can get it from her.
And there's been a couple of questions about the state map, and I will talk about that during my resource discussion. I have gotten some responses that from other listeners. For example, there is a financial institution in Massachusetts that allows just the student IDs for proof to open an account. There is a question: can WIOA programs actually pay via direct deposit? I personally know of at least 3 instances where it's at least partially funded WIOA programs that are paying via direct deposit. So that is something that I'll definitely look into, but it may be a policy at the local level as opposed to the national level. And then there was a question, and Ken, this is probably for Ken and myself, regarding national or the account standards. And for the FDIC, we have something that, again, I'll give you the web link during the resources discussion. That is our account standards, our safe account template that lists not only for youth, but it's account standards for everyone. And then there's also the Cities for Financial Empowerment. They also have a national account standard that talks about what a good account, a good affordable account would look like. And Ken, I'll ask you to answer that on behalf of the
Thank you, Tracy.
NCUA.
We have our mycreditunion.gov website where we include a lot of consumer financial protection and financial literacy information. On the site is an information graphic called Empowering Youth to Save, and we have listed the account features that NCUA encourages and that Director Bolaris mentioned in his opening remarks as account features that work best for young people. So we have that information, and there's a whole on that page on mycreditunion.gov, which I'll talk about in my section. We also have additional information from other agencies like FDIC and the Financial Literacy and Education Commission. So I hope that answers your question. If it doesn't, feel free to reach out to me directly. Thank you.
Okay, I think there's probably time for one more question, and it's about how do you integrate financial education along with accounts in your programs?
So,
and that's for anyone.
Okay, so this is Elena with First Metro Bank. So for us, when we're going out and we're doing financial education, we make it a point to never say, you know, oh, you need an account and you need it with us. It's very generic. And then if the student wants to open an account with us, we help them right there. We don't ever look at it as an advertising opportunity. For us, those are two very, ethically, we keep them very separated. Because that's what our board has directed us to do. And so, of course, we're going to follow the directive of the board. Now, I mean, we're going to, you know, when we're in the classroom, we're going to have on, you know, probably our First Metro Bank name tag, and they'll know which bank we're with. But we're not trying to, quote, unquote, sell accounts to any of the students. But we do make sure that they understand that that opportunity may be available in their high school. And that's pretty much as far as we go unless the student initiates the desire to create an account with us.
This is Amelia. I wanted to add on to that, and this is also true, I think, and Sylvia, please feel free to add on to this, or Julie, but that when we are setting up, when we're helping youth employers set up these financial institutional relationships, we really frame it as a kind of stopgap or safety net model rather than an exclusive partnership. I don't think an exclusive partnership between an employer and a financial institution is appropriate, generally speaking, and I certainly don't think it helps to build a lot of this autonomy and agency that we're talking about today. Instead, having these partnerships is something that adds a frictionless or minimizes the barriers and obstacles to young people opening first accounts if they don't have one. So the difference between making it available to remove barriers versus making it required is huge, and I would really like to emphasize that both of the programs on this call today definitely use that model.
And this is Julie, and I'll just, you know, add from a community-based organization's perspective, it's interesting because being in a smaller organization and now being in a larger organization, how those two models can look very different. In a smaller organization where we were explicit with our young people about our partnership with Latino Community Credit Union to take advantage of our workforce development opportunities within our organization, which was, you know, an ongoing a service and program that they had agreed to participate in. There wasn't an option to get paid. You got paid through your account at Latino Community Credit Union. That allowed us to look at their savings accounts. It allowed us to match their money seamlessly, and we explained to families that this was just part of the overall program. As I've moved into a larger organization where we're serving hundreds of young people through workforce development, we're not able to exclusively partner with one financial institution because we know that our families are coming in with histories with lots of different institutions. But we have remained steadfast in our commitment to only pay young people through direct deposit, which has helped us at least know that the money is going into financial institutions and it's not just being check cashed.
Great. Thank you, Julie. And now, Ken, I'm going to turn it back over to you to discuss the NCUA resources.
Thank you, Tracy. NCUA's consumer website, mycreditunion.gov, provides consumers with timely and practical financial tips, interactive learning tools, and financial resources. Content on the website is organized to provide information and resources to consumers at various stages during their lifetime and as they prepare for various life events like starting their first job, opening up a savings or checking account, and reading financial disclosures. The site is also available at a Spanish version of the site is also available at espanol.mycreditunion.gov. Here you can see many of the different topics our website covers, everything from what is a credit union to dealing with debt to buying a car and saving for the unexpected. All of our resources are also, like I mentioned before, available in Spanish, and the information is provided in multiple different formats, from web articles to downloadable brochures, videos, and some interactive learning tools, which I'll cover in a moment. We also provide a great deal of information through NCUA social media channels, so be sure to follow and like us, NCUA, on social media to receive regular updates on consumer financial protection and financial literacy topics. We also provide a great handy calendar of annual financial literacy events, topics, and opportunities that credit unions, their members, and consumers, and generally financial institutions can participate in throughout the year. The calendar is also a great way to create conversations at home from parents and caregivers about financial literacy topics. One of our featured resources is Hit the Road, a financial adventure game that is interactive and teaches young people the importance of saving and spending wisely. A group of young people go on a virtual road trip across the country, and they've got to learn how to save and spend their money wisely. It's based off of Oregon Trail, for those of you familiar with that game, that old school game. And here's some additional visuals of the different learning activities that these young people go through. And finally, our resources also on mycreditunion.gov includes our interactive information graphic on what is a credit union, talks about the differences between banks and credit unions, how credit unions are not-for-profit member-owned cooperatives. We also have the credit union locator tool, where consumers, including young people, can find a local federally insured credit union that they may qualify to join. With that, I will hand it over to Tracy.
Great. As you heard from our speakers, youth workforce and financial institutions are working together at a pivotal stage in a young person's life. The federal government and the nonprofit community have developed numerous resources to support these efforts. I invite you to explore the materials on the FDIC's Youth Employment Resource Center at www.fdic.gov/youthemployment. This site includes links to both FDIC and non-FDIC resources. The graphic on your screen right now is a crosswalk between the FDIC's Money Smart curriculum program and the Workforce Innovation and Opportunity Act's financial literacy element. This is available in an at-a-glance or booklet format. Money Smart is available in both instructor-led or self-paced formats, and we also offer a podcast. With delivery options, with the range of delivery options, you'll be able to find one that meets your program's needs. For programs wishing to implement instructor-led training, the FDIC offers quarterly train-the-trainer webinars, and if you don't have the in-house resources to provide training, we also maintain a list of 1,300 banks and nonprofit organizations that are available to provide Money Smart training in their communities. You can also find this list at www.fdic.gov/MoneySmart. Also on this particular website, you will find a Money Smart supplement for instructors and trainers that provides an in-depth explanation of what a young person should look for when selecting an account. And this resource aligns with the FDIC's Safe Account template, which I mentioned earlier, that gives all the attributes someone should look for in that first account. You can also find a link to that template from this resource center. The Conversation Starter, Ideas for Youth Employment Professionals to Help Youth Access Bank Accounts, was developed for youth coordinators and others working with youth programs who want to develop a partnership with a financial institution. This includes discussion of the account attributes found in the supplement and in the Safe Accounts template. The booklet suggests programmatic elements that you may want to share with financial institutions, including things like the number of participants, length of program, and age range. Finally, as was mentioned earlier, we also provide a link to the Conference of State Bank Supervisors statutory requirements for opening bank accounts for minors by state. This tool provides the legal age requirements by state for opening non-custodial accounts. And as we've heard earlier, it is not necessarily 18 years old. Some states are, as you can open a non-custodial transaction account as early as 14 years of age. Not included here and mentioned by Associate Director Hall earlier was the FDIC's Get Banked initiative, found at www.fdic.gov/getbanked. You'll find a variety of account-related materials, videos, and other resources. We also have a link to the Financial Literacy and Education Commission's resources that provide suggestions and examples for youth employment programs and financial institutions to work together to increase youth financial capability. These guides include examples beyond those we've discussed today, the account access and financial education. Finally, we link to a resource that workforce practitioners probably know very well. It's the Department of Labor-sponsored Career One Stop, found at www.careeronestop.org. For banks that would like to explore opportunities to work with youth programs in your communities, simply click on Find Local Help from this website, enter your location into the search box, and you'll find a list of American Job Centers and contact information for a number of different individuals, including youth coordinators. Similar to Find Local Help on Career One Stop is the FDIC's Bank Find, a tool that allows you to search for bank branches using a zip code or a city-state. Simply enter Bank Find in the search bar at www.fdic.gov's main page, or access it from www.fdic.gov/getbanked. So these two tools will help you in your partner search. And finally, what are the next steps? What we would ask that you do is consider how you can add value to a youth workforce program by forming partnerships. If you have any questions, need assistance finding a partner in your community, whether it's for financial education or account access, please reach out to me at tmorris@fdic.gov or Ken Worthy at KWORTHEY@NCUA.gov. And if you pursue partnerships as a result of this webinar, please let us know. We always like to showcase the positive impacts that our insured financial institutions are making in their communities.
Thank you, Tracy. This concludes our broadcast. This webinar will be available in approximately 3 weeks' time on ncua.gov. Thank you for attending.